All right, well, to say interest rates have come down might be the understatement of the day. LeBas, chief fixed income strategist over at Janney Montgomery Scott, joining us right now. Let's just start off with the two-year yield as an example. I am cherry picking, but it is a good cherry to pick. We were at 5%, over 5% at the start of March, and right now, if my Bloomberg terminal is correct, 3.815 and change, Guy. That, to me, is a recession call.
It is a very big and very swift decline in yields. We hit a local peak right around March 8th with Jay Powell's congressional testimony, and then shortly thereafter with the Maine banking crisis. Yields have just come cascading down. And in fairness, I think those of us in the bond markets, before we're allowed to listen to James Bullard speak, we need a little bit of a trigger warning, right? Last year, he was one of the Fed speakers who was extremely hawkish, pushing a much, much higher rate narrative. Mm-hmm. As we look forward from here, not only are two-year interest rates down, but the 10-year portion of the yield curve has come down as well. And the volatility in the shape of the yield curve has become really, really elevated. And historically, that volatility in the shape of the yield curve has been a little bit of a better timing indicator of significant economic downturn.
I am curious. I mean, when we talk about what the yield curve is signaling and what absolute yields are signaling, we've obviously seen all of the key measures on the curve, the 210s and, of course, the 510s and those 530s really come down or come up, or I guess depending. I always get that confused when they're a negative key. But is the bet here so much on Fed policy, macro conditions, or some combination of the two?
Well, I think it's a little bit simpler than that. Fed policy is intentionally constraining economic growth. Whether you believe neutral interest rates are 2 or 3 or even 4%, at the current level of interest rates, they're actively putting the brakes on the economy for all the good reasons to reduce inflation. But what that probably means is that 3 or 4 or 5 years down the road, overnight interest rates will average, that's kind of what the 10-year Treasury cares about, will average considerably lower than they are today, right? And so when that happens, you're more likely to get an inverted yield curve. It's really that volatility signal, the spread between either the 2s 10s or 2s 5s, if you want to move towards the front end of the curve, that really is a little bit more of a warning sign for more imminent economic stresses.
Guy, how at risk is the Fed then of overshooting? Because, yeah, we have got some weaker data, but weaker has to be in scare quotes. It's not like the data has completely fallen off a cliff.
Very much so, right? We're going to have a jobs report tomorrow morning, of course. There's very good odds that remains positive, that there's material job growth in the U.S. economy, and there probably will be for another few months here. That said, the early warning signs are all present, right? The Institute for Supply Management indices, both services and manufacturing, declined notably this month. Granted, they tend to issue many false positives of slowing growth, but there's a host of other metrics, and there's logic. Right? We have interest rates that year on year are up nearly 4% in round numbers, and that just has to slow activity in the housing markets, in the auto markets. Even if it takes a long time for this to pass through to the real economy, it is happening.
So is, 381, 3-month T-bill of 479, are we talking peak rates here? Are we talking terminal rates?
Well, it seems like we've already passed that for this part of the cycle, right? Of course, ask me again in a year or 2 years from now what the next peak is likely to be. But for the moment, it certainly seems like we've passed peak rates. And I think, many at the time were advocating or expecting perhaps Fed rates to hit 6% even. That seems pretty unlikely given what's transpired in the last 4 weeks.
How closely are you paying attention to the credit market, particularly when it comes to, I guess, some of the shakier names out there, or at least as a basket? A lot of folks were looking for that canary in the coal mine, and they still haven't found it. We haven't seen that blowout in spreads that a lot of people thought you would see if we are indeed headed into a recession.
Yeah, so that's one of the fascinating things about this period of probable economic downturn is that by most fundamental metrics, credit conditions, if you measure it by the debt to EBITDA ratios of the largest investment grade or high yield companies in the United States, they're unusually strong for this point in the cycle. And in fact, in much of 2022, they actually got stronger. And one of the reasons for that is that inflation helped boost incomes of many corporations, not all, of course, but many corporations, and they didn't increase the debt stock of those corporations. So if you just measure debt to income ratios, they actually improved during the year. And so it's a very odd position to be in, to have fundamental credit strength at a time when there's probably economic or market-based credit weakness in the cards. And so far, what that's manifested has been many dip buyers, the most obvious examples being last October and last January in credit. So for this cycle, I actually would not expect credit spreads to widen quite as dramatically as they have in the past. And the kind of 400 basis point mark for high yield spreads and the kind of 130 basis point mark for investment grade spreads really seems to be where the value buyers are stepping in.